why most retirement plans fail, and how to build one that survives reality. I've spent most of my life watching people do the same thing over and over again with money. They work hard, they save diligently, they follow the advice that sounds responsible, and then, quietly, almost politely, they destroy themselves financially in retirement. Not because they were lazy, not because they were foolish, but because they misunderstood what safety actually is. Most people believe safety means stillness, numbers that don't move, accounts that don't fluctuate, statements that look the same month after month. That belief feels comforting, especially as you get older. Volatility starts to feel like danger. Movement feels like risk. And risk feels like something you can no longer afford. But this instinct is backward. True financial danger in retirement doesn't come from movement. It comes from erosion. It comes from inflation quietly eating away at purchasing power while you congratulate yourself for avoiding risk. It comes from emotional decisions made during fear. It comes from being forced to sell assets at the worst possible moment because you structured your finances as if markets only go up. I've seen retirees with seven-figure portfolios panic themselves into poverty. And I've seen retirees with modest savings live comfortably until their last day. The difference was never intelligence. It was structure. And structure begins with understanding what retirement investing is actually for. Retirement investing is not about maximizing returns. That's what accumulation is for. Retirement investing is about endurance, about survivability, about making sure your money outlives you, not the other way around. And endurance requires a very different mindset than growth. The most dangerous lie retirees believe. The most dangerous lie retirees believe is this: if I just avoid risk, I'll be safe. That lie has destroyed more wealth than market crashes ever could. Risk is not volatility. Risk is permanent loss of capital. Volatility is temporary. Inflation is permanent. Bad decisions are permanent. Panic is permanent. A portfolio that fluctuates but survives is safer than a portfolio that stays still while being eaten alive by inflation and taxes. Comfort is seductive because it feels like safety, but comfort is often the enemy of survival. A bank account that never moves feels safe, but every year inflation runs ahead of interest, that account is quietly shrinking in real terms. You're not preserving wealth, you're consuming it without realizing it. This is why so many retirees feel confused. They did everything right, yet their lifestyle keeps getting smaller. Groceries cost more, healthcare costs more, insurance costs more. Everything costs more except the returns on the assets they thought were safe. That's not bad luck, that's math. Why products don't make you safe? People love asking for safe investments, as if safety comes in a box, as if someone can name a product that removes uncertainty from life. It doesn't work that way. Products don't create safety. Understanding does. You could own the best investments ever created and still fail if you don't understand why you own them. Conversely, you could own very ordinary investments and succeed if you understand their role. Retirement safety is not about picking winners. It's about building a system that prevents catastrophic mistakes. Most retirement failures don't happen because of bad assets. They happen because of bad behavior. Selling during crashes, chasing yield, overreacting to headlines, trying to fix things that aren't broken. That's why the biggest risk in retirement is not the market. It's you. Your emotions don't retire when you do. In fact, they often get stronger. Fear increases. Patience decreases. The margin for error shrinks. And the consequences of mistakes grow larger because there's no paycheck coming to fix them. So the goal of a retirement portfolio is not to impress anyone, it's to protect you from yourself. The 3 pillars of survival. There are 3 types of assets that, when combined correctly, create something rare in finance. Resilience. Not brilliance, not optimization, resilience. These 3 pillars are not exciting. They are not innovative. They are not designed to make headlines. They are designed to survive bad decades, not good years. Those pillars are reliable income from real businesses, broad ownership of long-term economic growth, liquidity that removes desperation, Each one solves a different problem. Together, they create stability under stress. Pillar 1, income that doesn't care about headlines. The first pillar is income from businesses that have already proven they can survive chaos. Most retirees misunderstand income. They focus on yield instead of reliability. They chase the highest number instead of the strongest source. That mistake is fatal. High yield is not safety. High yield is often a warning sign. It usually means the market doesn't trust the business. What retirees need is income that continues even when markets fall apart. This is why dividend aristocrats matter. Not dividend stocks, dividend aristocrats. There is a difference. Dividend aristocrats are companies that have raised their dividend every single year for decades. Not most years, not when convenient, every year. That history matters because it tells you something about the company's culture. You cannot raise dividends through recessions, wars, inflation, and financial crises without discipline. You cannot do it if your balance sheet is weak. You cannot do it if your business is cyclical or fragile. These companies don't rely on optimism. They rely on habit. People don't stop consuming basic goods when the economy slows. They adjust spending, but they don't abandon toothpaste, medicine, soap, or food. That makes these businesses unusually durable. Why income stability matters more than price stability. Most retirees say they want stable prices. What they actually need is stable income. Price stability is comforting, but it doesn't pay bills. Income stability does. If your stock portfolio drops 30%, but your income keeps flowing, nothing about your life needs to change. You still eat, you still pay rent, you still live. If your portfolio is flat, but your income erodes because inflation outruns yield, your lifestyle shrinks every year. That's why income stability is the foundation of retirement safety. Dividend-paying businesses allow you to live without selling assets. That matters more than most people realize. Selling shares during downturns is how temporary declines become permanent damage. Once you sell, recovery no longer helps you. Dividends allow you to ignore price fluctuations because you're being paid for ownership, not speculation. They also change your psychology. When markets crash and fear is everywhere, receiving cash is grounding. It's proof that the system still works, that businesses are still operating. That reality is calmer than headlines. That psychological anchor is priceless in retirement. Dividend growth, the hidden weapon against inflation. Many retirees look at dividend yields and dismiss them as too low. That's because they're focusing on the wrong number. Yield today doesn't matter nearly as much as growth tomorrow. A company yielding 3% that grows dividends at 7% annually will double its income roughly every 10 years. Your cost basis stays the same, your income rises. That's inflation protection. Bonds don't do this. Fixed income stays fixed. Inflation eats it alive. Dividend growth aligns your income with the economy. As prices rise, revenues rise. As revenues rise, dividends rise. You're not fighting inflation, you're riding it. This is why dividend growth stocks are superior retirement tools. They combine income, growth, and behavioral discipline in one structure. Why boring businesses win in retirement. Modern investing worships innovation. Disruption. Growth stories. Retirement should not. Exciting businesses change, sometimes quickly, sometimes violently. Entire industries disappear. Boring businesses persist. No one brags about owning toothpaste companies, but toothpaste companies don't vanish. Retirees should own businesses whose future looks like their past. Predictable, stable, uninspiring. This is not the phase of life for betting on what might happen. It's the phase for owning what already works. Pillar 2, owning everything instead of guessing. The second pillar exists to solve a different problem. Long-term growth without decision-making. No matter how well you structure income, you still need growth. People underestimate how long retirement lasts. 30 years is common. 40 years is no longer rare. Without growth, even good income strategies eventually fail. But growth does not require brilliance. It requires participation. That's where broad market index funds come in. An index fund is not a bet on a company. It's a bet on human effort. It assumes that people will continue to innovate, work, compete, fail, succeed, and create value. That assumption has been correct for centuries. Index funds remove the need to pick winners. They eliminate the danger of missing them. They also eliminate most behavioral mistakes. There's nothing to tinker with, nothing to outsmart. This is critical in retirement, when decision fatigue and cognitive decline become real risks. Why activity is the enemy of returns? Most investors don't fail because they choose bad assets. They fail because they can't leave good assets alone. They trade too much. They react too often. They confuse motion with progress. Index funds make activity pointless. You own everything. There's no reason to trade, no reason to adjust, no reason to react to news. That inactivity is a feature, not a flaw. Over decades, doing nothing beats doing something almost every time. Why retirees should stop watching the market. Watching the market daily is toxic in retirement. It creates stress without benefit. It invites emotional reactions to noise. It tempts you to act when action is harmful. Your index fund doesn't care what happened today. It cares what happens over decades. If you're not selling for 20 years, daily prices are irrelevant. This mental shift is hard. Humans are wired to react. Markets exploit that wiring. Index funds help by making reaction unnecessary. Pillar 3, cash as psychological armor. The third pillar looks like dead money to people who don't understand survival. Cash. Not because it grows, not because it's exciting, but because it removes urgency. Urgency is the enemy of good decisions. Cash allows you to wait, to think, to breathe. Retirees without cash are fragile. Any market downturn becomes a crisis. Retirees with cash are patient. Crashes become inconveniences. 2 to 3 years of expenses in cash equivalents transforms your relationship with risk. You are no longer forced. You are never desperate. That alone can add decades to a portfolio's lifespan. The truth about inflation and cash. Yes, inflation erodes cash slowly. Panic erodes portfolios instantly. One is manageable, one is catastrophic. Cash is not an investment. It's insurance against bad timing. It protects against sequence of returns, risk, emergencies, and emotional mistakes. Its value is not measured in yield, but in control. Control is what safety really means. Safety is not the absence of volatility. Safety is control over your decisions, control over timing, control over behavior, control over your response to fear. Cash gives you that control when nothing else can. The full structure, revisited. A resilient retirement portfolio looks like this. 40-50% income producing businesses, 30-40% broad market ownership time, 20-30% cash equivalents, 3 simple tools, 1 powerful system. You don't optimize this, you live with it. The final lesson. The greatest threat to your retirement is not the economy. It's not inflation, it's not markets. It's the moment you stop thinking clearly. The moment you panic, the moment you chase, the moment you confuse excitement with opportunity. Survival requires humility, patience, boredom. If you can accept being boring, you can accept being safe. And if you can accept being safe, you've already won. Why retirement breaks people who did everything right. One of the cruelest truths about retirement is that it exposes flaws you never knew you had. While you're working, mistakes are masked by income. Bad decisions don't show up immediately because the paycheck keeps everything afloat. You can recover quietly, you can pretend you're doing fine. Retirement removes that mask. Once the paycheck stops, every decision matters more. Every mistake lasts longer. Every emotional reaction carries consequences that can't be undone with overtime or promotions. This is why people who appeared financially disciplined for decades suddenly unravel when they retire. It's not because they forgot how money works, it's because the environment changed. Retirement is not a financial phase, it's a psychological one. And psychology, not math, determines who survives. The shock of no longer being needed. There is a psychological shock that almost no one talks about. When you retire, you stop being required. Your job no longer needs you. Your calendar empties. Your identity softens. That loss of structure creates a vacuum. Human beings hate vacuums. We fill them. Some people fill it with hobbies, others with family, but many fill it with financial activity. They start managing their money more aggressively. They check accounts more often. They watch the market more closely. They read more commentary. They look for ways to stay engaged. This is where trouble begins. Financial markets are not designed to be observed constantly. They are designed to be endured. The more attention you give them, the more likely they are to provoke a reaction. Retirees often confuse involvement with control. They think being active keeps them safe. In reality, activity usually increases risk. The market rewards patience. Retirement makes patience harder. Why fear feels louder after 60? Fear does not increase with age because people become weaker. It increases because stakes become clearer. At 30, a market crash is abstract. At 70, it's personal. You're no longer imagining the future. You're living in it. A drawdown is no longer a temporary inconvenience. It feels like a threat to survival. That emotional intensity changes how the brain processes information. Fear narrows thinking. It shortens time horizons. It pushes people towards certainty, even when certainty is destructive. This is why retirees flee to safe assets at precisely the wrong moment. They are not making analytical decisions. They are seeking emotional relief, and emotional relief is expensive. The illusion of control through complexity. Another common retirement failure comes from complexity disguised as sophistication. As people accumulate wealth, they are often told that simple solutions are no longer appropriate for them. They are encouraged to use advanced strategies, alternative assets, hedging techniques, and specialized products. These strategies sound intelligent, they feel exclusive, they create the illusion of control. In reality, complexity does not eliminate risk, it hides it. Complex systems fail in unexpected ways. They are harder to understand, harder to monitor, and harder to unwind under pressure. When something breaks, retirees often don't know why it broke or what to do next. Simplicity is not a lack of intelligence. It is a recognition of limits. A retirement portfolio should become simpler as you age, not more complicated. The older you get, the fewer moving parts you should tolerate. If you cannot explain every part of your portfolio clearly and calmly, you do not own it. It owns you. Why retirees are vulnerable to bad advice. Retirees are ideal targets for financial manipulation. They have assets. They fear loss. They value certainty. That combination attracts salespeople like gravity. Bad advice rarely sounds reckless. It sounds reassuring. It promises protection, income, stability, peace of mind. It often comes wrapped in authority, credentials, and confidence. What it rarely offers is transparency. Many retirees fall into trouble not because they took wild risks, but because they trusted the wrong people at the wrong time. They outsourced judgment when they should have protected it. The most dangerous phrase in retirement finance is, "You don't need to worry about this." Anything you own should be understandable. Anything you don't understand becomes a source of anxiety under stress. Anxiety leads to reaction. Reaction leads to loss. The safest retirement portfolios are not managed by the smartest advisors. They are managed by the clearest thinkers. Why selling feels rational during crashes. And during market crashes, selling feels intelligent. It feels decisive. It feels like protection. Your brain tells you that action equals safety. This instinct is deeply rooted in human evolution. When danger appears, movement feels like survival. Stillness feels like vulnerability. Markets exploit this instinct mercilessly. Selling during downturns locks in losses. It transforms temporary declines into permanent damage. Worse, it often leads to reinvesting too late after prices have already recovered. The tragedy is that most retirees who sell during crashes do not reinvest properly. They stay in cash too long. They wait for clarity. Clarity never arrives. Markets recover while they watch. They miss the rebound, confidence erodes further, the portfolio never recovers. All because of one emotional decision. This is why cash reserves are not optional in retirement. They prevent forced selling. They buy time. They quiet the survival instinct long enough for rational thought to return. Time becomes the most valuable asset. One of the most important shifts in retirement is that time replaces money as the scarcest resource. When you're young, you can recover from mistakes because you have time. When you're retired, time becomes finite, visible, and precious. This changes the cost of mistakes. A bad decade in your 30 seconds is inconvenient. A bad decade in your 70 seconds is catastrophic. This is why risk must be redefined in retirement. Risk is no longer volatility. Risk is losing time you cannot replace. Any strategy that requires perfect timing is inappropriate. Any strategy that depends on rapid recovery is fragile. If there's one thing I hope you take away from all of this, it's this. Building wealth is difficult, but keeping it is harder. And in retirement, the margin for error disappears faster than most people expect. You don't need brilliance. You don't need predictions. You don't need excitement. What you need is structure, discipline, and the ability to sit still when everyone else is losing their mind. Most people fail not because they didn't know enough, but because they couldn't control themselves when it mattered most. If you can avoid that one mistake, you're already ahead of the crowd. If this helped you think more clearly about money, retirement, or risk, take a moment to support the channel. Click like so more people who need this message can find it, and subscribe if you want more long-form, no-hype discussions about wealth, discipline, and financial survival. No shortcuts, no gimmicks. Just ideas that actually work over a lifetime. Thanks for watching.